All right, happy Friday, y'all. Welcome to the Power Hour training. It is Tiffanee Phillips, and today we're going to be going over the four quadrants of life insurance options, okay? So I want everyone to get a pen and a notepad, take some copious notes. So let's go ahead and rock this thing out. So, what are the four quadrants of insurance? Well, I'm glad.
Tiffany, you breaking up, and you height.
The first one, we're
Tiff, can
gonna
you hear us? Tiffany,
I can hear you.
you breaking up real bad.
I can hear you.
All right, keep going. But you was
Now,
breaking. I think you height.
hold on. Let me see if I do it from my cell phone because I'm choppy. Am I breaking up now, Kali?
No, that's 100 times better.
Okay, I just
So
need to
you
get a
probably want to start
stand.
over with getting a pen and paper because that's where you started
Yep.
breaking up.
I'm gonna just get a stand right here so I don't have to hold it. Hold on. And look at the work of the Lord. I just bought a brand new cell phone thing. He knew what I was gonna need.
Yep.
Okay, it's a little like off, but y'all can still see me, and I'm not choppy again, right?
No.
Okay, perfect. I need to go ahead and grab a pen and notepad. Take some copious notes. We are going to be interactive today, y'all. Now, I am limited because I'm on the cell phone now from being able to see the screen. So I just want everybody, when I ask a question and you want to answer, just go ahead and unmute. All right. So, what are the four quadrants of life insurance that we're going to discuss today? The first one, I want you to write down final expense. The second one, mortgage protection. Two words. The third one, IULs. And we'll go over what IULs mean when we get to that section. And last but not least, the fourth one is going to be annuities. Okay. So, starting off with final expense, I want somebody to unmute and tell me what they believe final expense is. Now, I don't want nobody to get voluntold, so come on, let's have some participants here. And it can't be like Amaka, Ash Cash, or KG, or you either, Cully.
Whole life, term life, accidental, anything regarding death benefit.
Correct. And I forgot to exclude you, but go ahead, Kev, because Kev been knocking it out the park lately, baby. Yes, sir. So, a lot of people get kind of caught up. Well, is final expense whole life? Final expense, you guys, is just simply is narrowing down on an age group. It's still life insurance. It can still encompass whole life, like Kev said. It still encompasses term. It encompasses a policy. So, what I really want you guys to focus on is don't let the verbiage confuse you. Okay. The money from the policy is still going to allow the client's beneficiary to take care of their final expenses upon their passing. A final expense, and this is a key thing right here that I want you guys to write down. Final expense is more exclusive for ages 40 to 85, but if you use Aetna, up to 89, because not all insurance carriers will cover up to age 89. I'm going to repeat that because it is very important. The final expense space is going to cover ages 40 to 85, but Aetna will go up to age 89. Like Kev pointed out, it's either going to be mostly whole life or term, okay? This is something that's very, very key, guys. And you want to write this down. Whole life is going to be far more lenient with their underwriting guidelines versus term, okay? And that is important to know because when we're going over our financial inventory sheet and we're asking the health questions, and everybody should have an inventory sheet. Mine's is in a book form. Oh, you can't see it because of the background, but that's okay. When you're asking the questions, I always choose to ask knockout questions first. Why is that important? Why I want somebody to unmute and explain why would asking knockout questions first be so important with the job that we do.
It'll prevent you
Okay.
from putting the people in the wrong insurance classification.
That is correct. I want you to dig a little bit deeper. And also, before you continue, everybody, this is a cameras on meeting, so we can be interactive. Please cut your camera on, especially for people that are directly on my team. We are guests on this call, and these are their rules. So, okay.
Tiff, you breaking up again. Tiffany frozen. Is it Tiffany or is it me? Tiffany, you frozen.
Yeah, it's
You hear
frozen.
me?
It's frozen.
You're frozen. Tiff stuck. Dean, while we waiting for, go ahead and say what you need to say about
I
that.
turned the
Okay, there you
Wi-Fi
go.
off. You guys can hear me now?
Yes, ma'am.
I turned the Wi-Fi off. That better help us.
So I think you were
Okay.
saying like everybody need to turn their cameras on. So we got iPhone, Lionheart, Phoenix. Where's the Mighty Lions? They're not on camera. All right, go ahead, Tiff.
Okay, cool beans. All right. So, Sunita, are you still unmuted?
I am now.
Perfect. Okay, so I want you to give your answer one more time, please. Or why
Okay.
why do I position the knockout questions first?
To avoid placing the client in the wrong category, and preventing them from getting denied. They need to, I mean, if they're within that age range of 40 to 80, we certainly don't want to put
85, 40 to 85.
Oh, let me correct my sheet to 85 in or 89 with Aetna.
Yep.
Yeah, we want to make sure that we're classifying them correctly, and we don't want to just be wasting time searching in areas that we could be moving forth with the correct policy.
And I want to hone in on the last thing you just said. We want to make sure we're not wasting time and we kind of get to the right product quickly. So,
Right.
This should be on everybody's sheet. If it's not, I will take a picture and send it because we have so much to cover today. I'm not going to go through them all where you will be able to write them down. What you catch, write down. These are knockouts. What is the definition of a knockout? Glad you asked. A knockout means if they have this condition, it's going to be a guaranteed issue policy. I'm going to repeat that. A knockout condition means they're going to get a guaranteed issue policy. Somebody else unmute and tell me what a guaranteed issue policy is, please. Don't be shy. Come on now. We do this all day, every day.
They don't have to go through medical underwriting?
They do not have to go through medical underwriting. And what does that entail, Kiera? Expound upon that just a little bit more for me.
Meaning that the health questions really won't matter based on their age.
Correct. There aren't going to be any health questions on a guarantee issue policy. I want us to really digest what guaranteed issue means. They are guaranteeing coverage. They're going to issue the policy no matter what the health condition. That also comes along with what, y'all? If they ain't asking no health questions, do they have immediate coverage,
Right.
or do they gotta wait a little bit?
They gotta wait.
Is it 2 years?
Yes, sir. More than likely, yes, sir. It's going to be 2 year, a 2 year proving period. Okay. So here are some of the knockout conditions: Alzheimer's, dementia, ALS, a terminal illness. A terminal illness is 12 months or less to live, or 6 months, depending upon the carrier. Dialysis, if they're currently on dialysis, if they have HIV or AIDS, any type of organ failure, if they are in an assisted living facility, if they are currently on hospice, they've had an organ transplant, if they're confined to a wheelchair or a hospital bed, and if they are currently on oxygen. Remember, I'm going to take a picture of this and send it. So if you didn't get it all, it's okay. We got a lot to fit in this hour. And the reason I like to ask the knockout questions first is because why would I go through all the details of getting the time frame of a heart attack, getting the time frame of a stroke, getting the time frame of diabetes, when it don't even matter? They not gonna get it anyways. So I might as well get it over with in the beginning to make my job easier and to make it a little bit more seamless for the client. So again, I choose to ask the knockout questions first because I just want to get it out the way if I gotta automatically shoot to a guarantee issue.
I got a question, Tiffanee.
Yes, ma'am.
What if I'm a person and I have one of those conditions and I'm 30 years old?
Ooh.
Great
So
question.
now I'm asking the group to see who has the answer to that. And it can't be Dean, can't be anybody who's been here for 6 months or more. Anybody know? Want to take a guess?
That's a good question.
I don't know, but I'll guess.
Okay.
My guess would be that it wouldn't matter, that it would still be the same.
Okay.
That would still be a knockout question. Like it would still be a graded policy.
Sunita, you just unmuted. Did anybody else want to guess?
I'll say the same thing. I mean, when it comes down to age, they had one of those knockouts. It's still going to be guaranteed.
Tiff?
So what I want, I can't see who answered. It sounds
It
like
was
that
Brittany,
was Kev.
Brittany and Kevin.
Okay, Kev and Britt. I want you to look at the notes that you wrote down for the ages of final expense. If the client is 30,
he's underneath the age.
correct. So so the question that she just asked, I'm glad she asked it here because there is an option. And I was gonna leave that for last, but because I didn't even think to insert that here. So what I would do in a situation like this, we have two options. You can position an accidental death policy because something is better than nothing. So yes, an accidental policy is just that. It's only going to pay out in the event of an accident. Okay? Or there is a product, and let me scroll down because that was my last point of the day. Now, this is going to be on an as needed basis. Don't be contacting your manager talking about, I need to get contracted with NLG. No, you don't. Okay. NLG has a product called Secure Fit Growth.
I didn't even know this.
It was posted in one of the chats, but Kylie know me. I'm a chat stalker and I'll be going through to find resources. So I am going to, I'm not on my computer anymore. I'll get this over. Let me write down a note. Secure Fit guideline, product overview. That's what it is. So let's say, for example, in this scenario here, we have a 30-year-old mom of 3 kids, and she's been diagnosed with HIV or AIDS. We want to position her for an accidental death policy. You cannot get it through Mutual of Omaha because through Mutual of Omaha, you have to have a health license. So if you don't have a health license, who knows what company you can write accidental with and don't have to have a health license? Everybody on here should be answering that because Kali gave us a training with the people a couple months ago.
Dun,
No.
dun,
Dun,
dun.
dun, 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 dun. It's AM. Yeah, AA Dean. He did it. Correct.
America as well.
And America, correct. They will let you write an accidental policy without a health license. So we will position an accidental policy and also the NLG Secure Fit Growth product because it's not asking no health questions and it's putting the money aside and letting it grow. Okay. Now, again, this is going to be on a as needed basis. This is not something you're going to proactively offer clients, but this is thinking outside the box as life insurance agents. And we have to make sure that we're always doing that. So great question, Kylie. I'm glad you asked it right here because it kind of fit with what we were going over.
I got one more trick question.
Yes, ma'am.
What if I'm 45? Because you said final expense starts at 40. So what if I'm 45 and I have dementia? I don't know.
So it's going to be guaranteed issue. As long as I can,
Woo-hoo.
Aetna will do guaranteed issue. It's called modified with them.
I think that'll just be a decline to
For ALS, you said, or
I
dementia.
I said dementia, yeah.
You are correct. That is an because it's dementia. I'm thinking about HIV or AIDS.
But even with that,
Even with what?
HIV or AIDS.
Nope. If you're 45, because I covered somebody. Oh, but that was with Great Western.
We don't have Great Western anymore.
That's another good. Yeah, we ain't got them no more, and I haven't been faced with that situation. So guess what I'm about to do? Pull up my handy dandy insurance toolkit because I don't know that one off the top of my head, and I'm all about using my resources.
So the answer we don't have any guaranteed issue for anybody. So even though final expense starts at age 40, we don't have any guaranteed issue for people that are under 50. So those knockout questions only apply to people that are 50 to 85.
That's good. Because that I did not know.
So we used to have a company that will cover people that started at 40 with those issues. We don't have that company any longer.
So everybody, let's write down in our notes, no guarantee issue for people under 50. So I just put GI is 50 to 85.
Which is different from final expense, guys. GI is a kind of final expense insurance. So does it mean that we don't have final expense for people under 50, just we don't have guaranteed issue for people under 50. So any of those knockout questions is going to be accidental You can offer them the accidental plus this Fit Secure Growth, which is a savings account. It's not a life insurance policy.
Yep. And that is the reason why I put the accidental and the secure fit together, because the secure fit is not, a life insurance policy. It's just an option of thinking outside the box for our client. All right, I have a few more points under final expense. I told you guys that the underwriting guidelines are going to be a little less lenient than with term. Okay. Also, we got to make sure we're painting the picture of what it looks like for the family not having it in place, and the fact, wait, what did my note say? He put in the fact that, it's there for them while they're alive. So final expense is going to have living benefits as well, y'all. So it is not set up how it used to be. If people have a heart attack, stroke, are diagnosed with cancer, can't perform 2 out of the 6 of their daily living habits, some companies even include Alzheimer's, dementia, as well as a terminal illness, the company will pay out. With America, their products will pay out 100% of the face amount. And remember this, y'all, facts tell, stories sell. Why am I bringing that up at the living benefits portion? Because when I first got started with FFL, Brian Mendenhall gave us 2 examples. His aunt worked at some big company. I don't know, let's just say BMW. She thought she was good. She had her work insurance. Well, guess what? She developed cancer. She could no longer work. They let her go. When she passed, she had no coverage. If she had her own private policy, not only when she was diagnosed with cancer, if she had America, for example purposes, would the policy have paid her out while she was still alive, she would have, more than likely, if she had not used it all up, had something for when she passed away. Stories sell. Here's another story, free of charge. There was a client who was diagnosed with a terminal illness. That means the doctor said you have 12 months or less to live. Okay? She took the money from her life insurance policy, packed up her mama, and her baby, and went overseas. The doctors overseas found a cure. Her life insurance policy saved her life. That is a story that will sell people. Always, always remember that. So living benefits are real. How many of us, and unmute because I can't see you, how many of us know someone who has had a heart attack, stroke, or been diagnosed with cancer? Just unmute and say me if you do.
Me.
Me. Oh, okay. Me. Sounds like we're getting ready for a singing thing here. So, living benefits are important, y'all. They're very, very important with these products. Know your product features. And again, I put on here, I guess I was feeling it. Again, facts tell, stories sell. So, let's do a quick recap of final expense before we move on to mortgage protection. For regular final expense, not including the GI that we did a little deep dive into today, what is the age range for our ideal final expense client?
40 to 85.
40 to 85. What company will go up to 89?
Aetna.
Booyah. What are the 2 main options for final expense? Somebody else other than Mark or Kevin. Come on, y'all. Look at your notes.
Whole life and term.
Booyah. True or false? Whole life is more strict on their underwriting guidelines than term.
False.
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 Booyah. Okay. So, number 2, mortgage protection. The purpose and the name of it is within itself. Mortgage protection is to protect the client's mortgage. Here is a story for you all to help bring this all in. Mortgage, when you get a mortgage, y'all, that document, you have certain insurance built into the mortgage payment, right? You have PMI, because if the client doesn't put down a certain percent, the lender like, hold on, player, if you default on this, I need to make sure I'm gonna get my bread, right? So people gotta pay PMI, and they pay the flood and fire insurance stuff if the house burned down and all that other good stuff. But the person who's not protected within the loan is the client. That's why we have mortgage protection in place. I used to be a licensed banker for JP Morgan Chase. So I've seen it far too often where people can no longer make the monthly mortgage payment. And guess what? The house goes into foreclosure. So here is how we protect our client. The mortgage company, like I said, has built-in insurance to protect themselves. But if something happens to our client, they're technically screwed. So right now, I have a client who was diagnosed with prostate cancer for the second time. The second time. He had to quit his job. He could no longer work because he was so sick. If you ain't got no money coming in, you can't pay your bills. His house went into foreclosure. So let's take a deep dive into what's the point and purpose of mortgage protection. If you've ever seen one of the notifications that go out to clients in the paper form, it is crystal clear on this will protect you in the event of sickness, disability, or death. What is sickness? We getting back to the living benefits. Heart attack, stroke, cancer. What would an example of a disability be, y'all? Anybody?
Can't walk.
You can't walk. That's 2 out of the 6 of daily living habits. Okay? So a sickness, a disability, and God forbid if the client passes away before the mortgage is paid off. So we're either going to have a homeowner that is married or a homeowner that is single. You're going to take 2 different avenues because, Mark, are you married?
No, I'm happily single.
Okay, single and ready to mingle. Who on here is married? Kevin, ain't you married? I seen them pictures of you and your wife on Facebook. Unmute for me, sugar.
Yes, ma'am, I am.
So do you and the missus rent or do you own?
We own.
Okay, perfect. Who's responsible for the mortgage? You or your wife?
I am.
You're responsible for the mortgage. Kevin, how long have you had your mortgage?
Going on 3 years.
Going on 3 years. Did you take out a 25-year mortgage or 30 years?
30.
30. Okay. How much is your monthly mortgage payment?
25 or 2,600.
2,600. Woo wee. All right. And what's the approximate balance left on your home?
286,000.
Okay. 286. Now, Kevin, with you being solely responsible for the mortgage, what would it look like? And I'm sorry, what's your wife's first name?
Deasia.
Deasia.
Yep.
Okay. What would it look like for Deasia today if you didn't come home last night in regards to the monthly mortgage payment?
It won't look too good.
It wouldn't look too good. What do you mean by wouldn't look too good?
She had to actually start, take my money from my insurance to help her out, and then she had to find her a better income job to stay in the house. The house. Yeah.
Okay. So,
Yeah.
and just help me out, correct me. I just want to make sure I'm hearing you right. God forbid you didn't walk through the door last night. When it's time for that monthly mortgage payment to be made next month, Deasia would struggle.
Yeah. Yeah.
Okay.
She probably get a month or two off, and then after that, it's kind of like she had to start dipping to her 401k and all
Mm.
that. Yup.
And that would have to be technically a qualifying event. I'm glad you brought that up because the mortgage is just in your name, right?
Right.
So it sounds like, in addition to finding you some options to where if you get sick and can no longer pay the mortgage, or God forbid you pass away before it's paid off, we need to get it set up to where if something, again, God forbid, does happen, we can get that mortgage in her name, right?
Right.
Okay. Thank you, Kevin, because that turned into a role play
Oh,
and
you
I
welcome.
wasn't intending on it. But this was a really good example because you got to find out what's the balance on the home, y'all. Write this down. You got to know the balance on the home, the monthly payment. You also need to find out how much time is left and how long they've had it. How much time is left, how long they've had it. And it matters if they're married or single. Because now, what did Kevin tell us? What I didn't tell Kevin. Kevin told us. What did Kevin tell us about Deasia?
That she wouldn't be able to afford the mortgage by herself right now.
She wouldn't be able to afford the mortgage by herself. And I want somebody to hone in on why is that important? Why is it important for us to know that?
You need to know how much mortgage protection that you actually need when it comes down to the policy.
That is correct. The answer I'm looking for is more of on the emotional side of it.
Because they don't want to leave somebody that they care about with the possibility of not being able to stay in their home.
Correct. If we don't get you properly protected, you just told me Deasia gonna be homeless. I didn't tell him that. He told me. And it might not be immediate that Deasia might face being homeless, but Kevin told me it would come. What did he say she would do? And not the same people that's been answering. Lady Faith, what did Kevin say when we did that role play just now about Deasia?
That she would have to dip into her 401k.
She would have to dip into her 401k. Now, did anybody notice the pivot that I made with that? Because you got to use active listening skills.
I do.
Not you, Kevin. You tripping. Athena, what did Kevin, you made me forget my question. Help me out, child.
What pivot did you make when you heard
Yeah,
about the
what pivot
401k?
did I make? Athena, what pivot did I make when he brought up she would have to go into her 401k?
I'm sorry. In this moment, I don't recall. I was writing down.
Somebody help her out.
Is it when you played it back, ma'am, to help to play back what he said, ma'am? So basically she would struggle?
No. So Kevin said she would probably take 2 months off of work. And then after that, she would have to dip into her 401k. And then I said, well, correct me if I'm wrong, Kevin, but you told me the mortgage is in your name, right? He said yes. Guess what? It has to be a qualifying event to take out money of a 401k, y'all. If that mortgage ain't in her name, she ain't getting it from the 401k. So this is why we have to use active listening skills when we're talking to our clients. Because now the door was open for me to position Legacy Safeguard. Not to throw up on them and give it to them all at once, but to plant a seed of, it sounds like we need to get something in place. So if you pass away before the mortgage is paid off, she'll be straight to be able to take out a loan from her 401k. Because right now she can't, because she nowhere on that mortgage balance. Okay, so also with mortgage protection, we're going to have two options. Because when I first started mortgage protection, I was like, oh, we got to cover the entire balance of the mortgage. We got to cover the entire balance of the mortgage. Everybody might not be able to afford that. You don't want to leave the customer with a second mortgage payment. You want to make sure it's affordable. So this is important. Write it down. In Kevin's example, after I dug a little bit into the budget, but on the surface, it appears my first option that I would have taken for him would be to cover 100% of the balance, 75% of the balance, or half of the balance. That is going to be your option one. And I'm going to be real honest. Some people I've seen struggle with this. Some I didn't struggle with it. So I never want to assume that it's easy. But when Khalid first invited me to the training call, I don't know how many people on here can remember, there was a young lady who did mortgage protection with us 1 or 2 days a week. And she talked about either doing this option, which I just went over, or equity protection. This is going to be the second option, y'all. Equity protection. What is that? This is the way I need y'all to think about this, because it's the reality of it. Let's say, God forbid, Kevin passed away before the balance was paid off. The lender, let's say it's Chase, did not get a notification in the mail that said, your client Kevin passed away. Okay? They're not going, oh, on the next mortgage payment due date, we need this whole balance. No. Chase still want their interest. They want you to take the 30 years so they can make that extra bread. All Chase is saying, if your mortgage payment is due on the 22nd of each month, give me my money. What that means, say, give me my money. That's what the mortgage people want too. They want their money. So they're not concerned about the ins and outs of it. If the due date the 22nd, make sure they got their bread on the 22nd. Equity protection can help somebody do that. Let's say there may be a little bit more seasoned in age. Maybe we're talking to somebody who's between 60 and 72, and they might not be able to get a term. I don't know. Maybe their budget don't fit for them to pay more than an extra 50, 60 bucks a month. Well, what we want to do, and here's the second option. You're going to find option one is going to be 6 months of their monthly premium. Somebody unmuted, so mute yourself out. We're going to do 1 year of the monthly premium. and I give an option of 2 years. Now, dibble dabble with it how you want. You could do 6 months, 9 months, or 12 months. I don't care, but just make sure it's 3 options. So when we're looking at mortgage protection, we're either doing the first option is 100% of the balance, 75% of the balance, or 50% of the balance. If we're doing equity protection, it's 6 months of mortgage payments, 1 year of mortgage payments, or 2 years of monthly mortgage payments. Again, when you're on the phone in the trenches talking to these people, you got to be able to make that mental shift. You have to, and you'll be able to do it once you get really, really, really good at discovery. So this is what it's going to sound like with someone we're doing equity protection with. Mark, do you still have a mortgage on your home?
I do.
Okay. So Mark, are you single or married?
Happily single.
Okay. Ready to mingle, huh, honey child? So Mark, let's say God forbid you passed away before the mortgage was paid off. What do you want to happen to the home?
You could divide it up to all my girlfriends.
Well, how many girlfriends you got?
Too many.
Okay, now Mark, come on now. We need to come with us something real. You got kids?
No, ma'am.
No kids or anything like that. So who would be responsible for getting the house cleaned out and stuff like that? God forbid you passed away before, the mortgage was paid off.
I probably leave that to my brother.
Okay, so your brother would be the beneficiary, correct?
Yes.
Now, Mark, remind me again where you live at.
I'm sorry, I didn't hear you.
Where do you live?
Alexandria, Virginia.
Okay, does your brother live in Virginia with you?
He lives in Connecticut.
Okay, so he would have to travel
Oh, yes.
to get things taken care of. Is he working or retired?
He's still working.
Okay. And he has a family of his own?
He's got 3 more years to retirement.
Okay, 3 more
Actually,
years.
he's a Catholic priest. He lives at the church.
Okay, all right. So he would have to, travel down to Virginia, get some help getting the home cleaned out and getting it up to speed for it to be sold, correct?
Yeah, and this might cost a little more because what he'll probably do is come down with a truck or a pod, put everything in it, and take it back to Connecticut, which is probably going to cost even more.
Possibly. I'm glad you brought that point up. So let me ask you this, Mark. How much is your monthly mortgage payment?
$1,200.
1,200?
Yep.
Okay, 1,200. And what's approximately the remaining balance?
Well, there's a condo fee too.
What's the condo fee, child?
500
And then how much approximately is your balance
on
on
the
the
house
mortgage?
mortgage.
Mhm.
I think it's around 130, 140.
130, 140. Okay. And then how long have you had the mortgage?
Oh, about 15 years now.
Did you take out a 20, 25, or 30-year term?
30-year, but I did a refinance, so it's going to take longer to. I added about 10 more years to paying it off now.
Okay. All right. So, boom. Okay. With this role play right here, I'm taking 1,200, and this is how I would come up with it. Oops, I thought my calculator was pulled up. Somebody help me out. What's 1,200 times 6?
1,200 times
7,200.
7,200. Thank you, Ashley. What's 1,200 times 12? Oh, well, does double of that, but 1,440.
400. Mm-hmm.
What's 1,200 times 24?
28,800.
Correct. So my 3 options for equity protection or buying time is going to be 7,200, 1,440, or 2,880. It's that simple. All right, so let's do a quick recap because we only got 15 more minutes and 2 more areas to touch. What are why do we offer mortgage protection? Mark, you can't answer. Kevin, you can't answer.
To
Still,
protect those after you die, the people you care about or whoever you're passing it down to.
I want you to get more specific. What exactly is this product? Who is it protecting?
The people, the person.
Okay, sorry. What is it protecting?
The mortgage itself.
The mortgage itself and the client. Yes, 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 Sugar Lump. Now, when we are looking at the balance, y'all, how much should we be covering in our 3 offers?
50% of the mortgage or 100%?
No, don't guess. Look at your notes. I hope I'm pronouncing it correctly. SEIF. Unmute for me.
Yeah.
How much are we covering when we're looking at the 3 options for the balances of the mortgage?
Damn. When we at 1440?
You looking at equity protection. Did you take notes?
Well, that's where I stopped at. I didn't take any further notes.
Okay, perfect. Somebody help them out.
50% of the mortgage, 75% or 100%.
Ooh, yeah. And then when we're looking at equity protection, not the same person, what are we looking to protect? What should our 3 options be? Let's ask it that way.
6 months, 1 year, and 2 years.
You got it. Booyah. Okay. So there we go with something else I wanted to point out with mortgage protection. You have to know your carrier, because, and an example I'm gonna give is Ethos does have an option, but for mortgage protection, and whoever that is, mute out for me, because Ethos only pays out 25% of the face amount. If we're positioning this is great if you have a heart attack, stroke, cancer, can't work, you need to pay the mortgage. But why would we get them something that only pay out 25% of the face amount if they need to utilize the living benefits? We wouldn't be doing a good job by our client. So I want to make sure that if you want to choose mortgage protection, I would highly recommend picking 3 carriers and you knowing the living benefits like the back of your hand, and do not use Ethos unless you look at their new term product with living benefits. You want to make sure it has a high payout amount. Okay, so IULs. We about to get through IULs. It's 3 buckets with IULs, y'all. Living benefits, life insurance, and cash value. Living benefits, life insurance, and cash value.
And Tiff, you don't have to go too much into detail because next Friday, Amaka is going to be going, and the whole hour is going to be about IULs.
Okay, perfect.
Yeah.
So with IULs, of course, we've gone over living benefits. This will be the 3rd time, so we know how important that is. But how an IUL works is, with those 3 buckets, every month the client is paying into the life insurance portion because there's a cost of having life insurance. A portion of it is taken out of that life insurance bucket and put into the cash value bucket. That's it. That's all. Don't overcomplicate it for people. Now, depending on the age, more might be going towards the life insurance because life insurance is based upon 2 key factors. Somebody unmute and tell me what it is.
Age and health.
Age and health. That's it. That's all. So the older the client is, the less is going to be taken from the life insurance bucket and put into the cash value bucket. That's all. Oh, and you want to make sure you know your guidelines for things like this. I will use myself as an example because I completely messed up last week. That is my fault. I did not ask a knockout question until I got to the IUL application and he said yes. A knockout question for IUL is drug or alcohol treatment within the past, some of them is 8 to 10 years. His was 7. I shot myself in the foot because then I had to go back and reposition a regular whole life policy. And he was like, oh my God, that's too much money. But that was my fault. So another example is I had a client who was not diagnosed with diabetes before the age of 45, but Mutual of Omaha didn't like that she took 2 diabetic medications. So they was like, nope, girl. But guess who is diabetic friendly? Foresters. If you don't study, and I don't, God no, let me tell you that I don't want to say study, because some of us can get so caught up in that and be trying to do stuff during working hours. When I say know your product, don't have the opportunity to be on live dial making phone calls. So let's just be crystal clear on that one, child. Know your product in non-production hours, okay? So I knew they were diabetic friendly, but I wanted a simplified issue. I didn't want to go someplace like F&G where it could take 2 to 3 days. They say they getting better. I don't know. But she was denied an IULE with Mutual of Omaha, but approved with Foresters. So just know your products. Know, and this is so important with an IUL. Know the difference between a 401k and an IUL. I have a sheet. I'm going to drop it. I can't because I'm not on the computer anymore because we was having some technical difficulties. Know the difference so you can explain it and paint a picture for them. Whenever I talk about the difference between a 401k and an IUL, I use myself as an example. When I wanted to put Jaden in the first private school he ever went to, I didn't have the cash on hand, but I had a lot of money in that 401k. But guess what? It had to be schooling for me. So yes, I lied to Comcast and told them I was going back to college so I could pay for my son to go to private school. Because at the end of the day, it's my money. Don't be asking me no questions. But anywho, all right. And and I'm also going to provide you guys with the IUL handbook. It's totally dope. The fourth option, we're going to dig into annuities. I'm not going to take too much time with this, maybe about 2 minutes, because I want to open it up for questions. With annuities, because I used to be this person. Oh my God, how did they close that big annuity deal? Where are they finding these leads? Where are they getting these people? Oh my God, they got a secret lead source. No, they don't. They know how to ask the golden question. Do you have anything that acts like life insurance? Do you have anything that acts like life insurance? For example, 401k, stocks, bonds, mutual funds, savings, money under the mattress. Because it'll act like life insurance because it has a beneficiary attached to it. And upon their passing, the beneficiary will get the money. Hi, Jaden. And I go a little bit deeper. If they got a 401k, stocks, bonds, stuff like that, I ask them, are you excited or terrified when you look at it and check the balance? And you got to have, some drama with that. Excuse me. Are you excited or terrified? Most people going to say, oh, it stresses me out. Pretty sure. Would you be interested in just learning how you can protect that money and no longer participate in market loss? I'm going to say it one more time. Would you be interested in just learning how you can protect that money and no longer participate in market loss? So we got 5 minutes left. I want to open it up for questions. If you have any, I'm working right now. Give me 5 minutes. I'm working. See, he come in here. No, think the world revolve around him. It do though, but back up because I'm still working. Questions, comments, concerns. Khalid or KG, feedback.
As far as the annuities go, find an annuity dealing with a old 401k, as long as it's not active, right? It can't be an active 401k, correct?
Correct. They cannot be actively contributing to it.
Okay.
Yeah. So that was a good question. To kind of hone in on that, you can say old 401k from a previous employer, because it wouldn't make sense to go build an illustration for a 401k and they still actively working. So good point.
Okay.
Yeah, I have a question for you.
Yes, sir.
Is there a minimum age that the person has to be in order to put the money into an annuity? So let's just say they're 25 and they have 80,000 in an old 401k from an old company. Would they be able to convert that or no?
They would, however, you're gonna have to go through some suitability stuff with the carriers. I like the illustrations that Athene and F&G do, but I want you to speak with your direct plugged in manager so they can guide you on what they utilize. Because now you got to factor in, are they going to need the money before they 59 and a half? You know what I'm saying? So great question. And it might be a situation where you don't roll all of it. You could just roll some of it. Did that answer your question?
It did. Thank you.
You're welcome.
Now, say they move some money over to a thing, right?
Mm-hmm.
And does it work the same way as a 401k where they gotta get approval to take some of the money out if they need it as an emergency?
With a annuity, there is going to be a tax penalty before the age of 59 and a half. As far as the restrictions and giving a reason why, like a 401k, I do not believe so.
Okay. Thank you.
You're welcome. All right, y'all. Well, if we don't have anything else,
just a
do the
couple
leaders have
reminders.
anything they want to add?
Yeah, let me add a couple reminders. We have script training at 1:00 with, I don't know, it might be Kevin. Kevin, you free at 1 Eastern?
Yeah, I just gotta get to Sean's call and record it.
That's at noon.
Is that noon? Okay.
That's like immediately after this.
Okay, cool. Yeah.
Okay, because I know Amaka is busy at the moment. So
I asked him already. He tracking.
Huh?
I asked him already. He tracking.
Okay, my bad. Y'all figured it out. Okay.
Can
So
you guys drop the flyer in the
it's the same
Discord?
Zoom.ffl Fury. It's this link, and
I just like flyers.
I'll give it to you. I have no worries. I'll send it to you. But so it's gonna be the same link, but it's a breakout room called script training. So we do script training Monday, Wednesday, and Friday at 1 p.m. Eastern, and at Tuesday and Thursday at 8 p.m. Eastern each week. And then make sure you guys, if you are licensed, we have mandatory training on Saturday at 11 a.m. Mandatory compliance training. So it's things that we go over every year to make sure that everybody's on the same page. So just a reminder about the training on Saturday. So I'll put all of those flyers in Discord as Tiffany requested. All right, let me stop the recording.